Hi everybody, welcome back to our continuing discussion of Chapter 11. In this video, we'll discuss stock dividends and stock splits. As always, I strongly recommend that you download and print the PDF version of the worksheet or download the Excel workbook so you can follow along and practice with the video. Stock dividends are discussed in your textbook on pages 423 through the very top of 425. A stock dividend is a distribution of additional shares of the corporation's own stock to its stockholders rather than a distribution of cash. A stock dividend keeps the stock price affordable on the stock market by increasing the number of shares outstanding, but does not change the amount of equity. It simply reclassifies some of the corporation's retained earnings to stock. Small stock dividends is a distribution of 25% or less of the outstanding shares of the corporation. A small stock dividend is recorded based on market value of the shares. A large stock dividend is a distribution of more than 25% of the outstanding shares of the corporation. A large stock dividend is recorded at par. Let's practice. Example 1, small stock dividend. The directors of Hercules declared a 10% stock dividend on March 31st. At that date, the corporation had 20,000 shares of $5 par value stock issued and outstanding. The market price of Hercules stock on March 31st was $25 per share. Step 1. Calculate the number of shares that will be distributed as a stock dividend. There were 20,000 shares issued and outstanding, and the corporation is going to distribute an additional 10%. So 20,000 shares times 10% equals 2,000 shares that will be issued as a stock dividend. Step 2. Calculate the amount of the dividend. And remember, this is a small stock dividend because it is 25% or less of the total outstanding shares of the company. So it's a small stock dividend, and a small stock dividend is recorded based on the market value of the shares. So the amount of the dividend is going to be based on the market value of $25 per share. 2,000 shares to be distributed at $25 market price per share equals $50,000 dividend. Step 3. Calculate the amount that will ultimately be credited to the common stock account. 2,000 shares will be distributed, and we're going to credit ultimately the common stock account for its par value. So 2,000 shares times the $5 par value equals $10,000. We now have all the pieces necessary to record the declaration of this stock dividend. Debit retained earnings, $50,000, which is the amount of the actual stock dividend itself based on the market price. Credit common stock dividend distributable, $10,000. And credit paid in capital in excess of par value, common stock, for the difference, $40,000. On June 15th, the stock dividend is actually distributed. The shares of stock are actually distributed to stockholders of record. Write the journal entry necessary to record the distribution of the stock dividend. Debit common stock dividend distributable for $10,000 to remove this obligation from the books. And credit common stock $5 par value, $10,000, because the stock has actually been issued. Well, that was an example of a small stock dividend. Let's do the same, mostly the same facts, but make it a large stock dividend. The directors of Hercules Corporation declared a 30% stock dividend on March 31st. At the date of declaration, the corporation had 20,000 shares of $5 par value stock issued and outstanding. The market price on Hercules stock was $25 per share. First, we need to remember that a large stock dividend is not based on the market share, it's based on the par value of the stock. So let's calculate the number of shares that will be issued as a stock dividend. 20,000 shares issued and outstanding before the stock dividend times 30% dividend equals a stock dividend of $6,000. Step 2, calculate the amount of the dividend. That's the par value of the stock. I made a mistake right here. It's 20,000 shares times 30% is 6,000 shares that will be distributed. Now calculate the amount of the dividend based on the par value of the stock. 6,000 shares at $5 per share par value equals $30,000 dividend. Now we have everything we need to write the journal entry required to record the declaration of the stock dividend. Debit retained earnings for the amount of the dividend. Credit common stock dividend distributable, $30,000. On June 15th, the company actually distributes the 6,000 shares to stockholders of record at that date. Write the journal entry necessary to record the distribution of this stock dividend. Debit common stock dividend distributable, $30,000. That zeroes out this obligation here. And credit common stock, $5 par value, $30,000, because we actually distributed the stock on June 15th. Let's talk a little bit about stock splits. Stock splits are kind of similar to stock dividends in that the corporation actually does distribute additional shares of stock to the stockholders, but it is not a dividend. A stock split just simply means that the corporation calls in the outstanding shares and reissues more than one new share for each old share. No journal entry is made for a stock split. The capital and retained earnings accounts are not changed. It decreases the par value of the stock and increases the number of shares outstanding. Well, that's all for this video. In our next video, we'll talk about treasury stock.